Hello friends, on behalf of my channel Classic Ones, I welcome you to a brand new course about security analysis for investments. And today's video is about introduction to valuation. So before starting off, a quick disclaimer that using this particular module or the set of videos or playlists, I will not promote any so-called advanced paid course in any other platform. This is just to increase the knowledge of the viewers and help them understand personal finance concepts which they can use in academics as well as in real life. So this is the purpose of this course. So let us start. So, if you talk about the philosophy behind any investment, so it is very basic. That is, don't pay more than the worth of an asset. It seems very obvious and nothing very serious also. But still, in history, we have seen many times this particular principle or concept has been violated, and it has been rediscovered again and again that this has to be done. And then why this has happened? So I suggest that you just look into yourself and answer a few questions like how many times you just invest in an asset just by getting motivated by the crowd or by your friends or family or maybe your colleagues. Many times, like, we just do not evaluate the actual value of an asset, of a security or anything like bond also, and just invest in those assets just by looking at other people's faces. So once we do that, we expect that since everybody else is purchasing this asset, so it is natural and it is expected that the value of this asset may be really valuable, and in future also the growth of this asset is guaranteed. And in deep down, we also know certain facts, certain real facts like reality, like the revenue stream of this company may not be that much encouraging. Secondly, the profit margin is too thin. Thirdly, there is no competitive advantage is less. So if any competitor emerges in the near future, nothing else is there for this company to retain the revenue or the profits. All these things may be known to us, but still we choose to invest in those companies or in those assets simply because other people are also doing the same. So in our minds, two things are acting basically. First of all, like I said, that many are investing, so why not? So first of all, first point is many are investing, so why not me? So let me also invest, otherwise I'll miss out something. I am missing out, so let me also invest. That is the first psychology that is occurring. Secondly, we think that okay, maybe this asset is not so good, but now it is like its value is increasing like anything, so let me invest now here. Maybe at certain point of time, maybe in the future, this asset may fall like anything, but I will exit somewhere around here. You think that you are purchasing this at this time point t1, and then you think in T2 you will exit, and maybe you have some idea that in T3 here this asset will start falling, the value of this asset will start falling. So that is your idea, and you think that you are safe here. So up to from T1 to T2 you can do this, and still you will profitable. But the point here is the value of the asset is not falling by itself. Like, people are there who are responsible or who are actually controlling this in the market. And the first assumption, if you see, many are investing, and out of these many, if you draw this pie chart, that means the number of investors for this asset, the pie will look like this much is your retail, and this is the institution. And these institutions are not people like you and me. They exactly know when to enter and when to exit. You don't know, you and I don't know. So we think that we will be very clever of like selling this asset here, and you actually don't know this point, this particular point where it is going to occur, when it is going to occur. So therefore you think that when you will sell this asset, there will be some kind of joker fool or some people around there who will buy that. So you are waiting for that, and when we try to sell this, we will find that nobody is actually buying that, and that joker or whatever is no one else but us. Okay, so that was the point I wanted to discuss here. So now let us come to the actual technical discussion. So if you are talking about any financial asset, so there can be two things: either it will be controlled using emotion or by cash flow. Now, financial asset, unlike of any other assets, cannot be evaluated using emotion. For example, if it is a painting or a sculpture or any artistic component, any that kind of asset, then emotion has a very big role to play. Anybody can pay anything for that asset if emotion is used, and emotion will be there. But for financial assets, there is no role, there should not be any role of emotion. It is purely based on cash flow. So if an asset is generating cash flow, that means cash flow is increasing, then the asset is valuable. Otherwise, if the cash flow is decreasing, and in the expected future also it is expected that there will be reduced cash flow or even zero cash flow, then the asset is not valuable. And just to mention here, cash flow can be this can be present cash flow, that means the cash flow that is happening in the present time, or it can be future cash flow also, means expected cash flow that is not occurring right now, but in future it is expected that this cash flow will occur. So both can be considered, and based on both, the valuation of financial assets can be carried out. But the principle is this: the cash flow should be positive or encouraging for an asset to become valuable. Otherwise, it is not valuable. So what should be the basic guideline for investing in any asset? The worth of the asset, which is governed or which is measured by the cash flow. So these two terminology are important: worth of an asset and the underlying cash flow. Okay, so there is a debate or some kind of discussion around what is evaluation. Is it an art or is it a science? So basically, if it is a science, then there is little room for error or like adjustment or ambiguity, and everything is done or conducted using analytics analytics, and on the other side it is complete art, or in that case everything is manipulated using bias. And what is the actual reality? The actual reality is like anything, like any other continuum, or it is like in the middle. And what does that mean? That means that it is analytics also. Analytics is the core of valuation, but there is room for bias also. The sources of bias are already there, and we will see what are those sources. But it is very difficult to remove or eliminate those bias. Basically what we can do is we can minimize the role of that bias, but it is almost impossible to eliminate that. And of course, out of all methods of valuation, we will prefer analytical methods, which we'll learn in subsequent videos. And then what are the sources of bias? So it depends on who is the analyst and why he or she is evaluating the security. So there can be two cases. One thing is you are the analyst and you are doing it for your own sake. So you want to invest and you are analyzing. So then three things can happen. First of all, value first, then valuation. What does that mean? That means suppose you are evaluating a particular firm, for example, say Facebook. Okay, now it is Meta, or say Twitter. I don't have any bias for these two companies, just they appear in my mind, so I am writing these two names. This has got nothing to do with recent news, maybe. And then so you may have certain kind of stories going on in your mind about these companies, Meta or Twitter or whatever, and based on those stories, you already have a preconceived idea about these firms. And so even if you are starting your valuation, it is not getting started from a blank slate. So that is the point. So that is one source of bias. Then the next one is the information that we are collecting. So for example, you are looking at the annual reports. So there are two parts. One is your data, for example, income statement, balance sheet, cash flow statement, and so on. Okay, I am assuming that these are exactly perfectly maintained data, and there is no ambiguity about that. But there are also qualitative factors. For example, the CEO is saying something, the technology adoptions that will happen in the future, all those news are already there in the annual reports that you are reading and interpreting in your own way. So if you want to include all those information, that can be a source of bias. Then there is market's own evaluation or own estimate. Like for example, if you are finding a true value or the intrinsic value of a particular asset, suppose say $15, and then in the market it is $25. So you will try to find some kind of logic or some kind of story just to justify this gap. So from that also some kind of bias can generate. Okay, then the second thing is it is also possible that you are doing this valuation activity for someone else. Someone else means some institutions. Someone else means not for me, like for some institution. And institutions, in many of the times they are corrupt in a certain way. Like, what is the goal of the institution? For example, if this institution is an equity research firm. Okay, so an equity research firm will always tell their customers that some kind of security is very good to be bought. So buy signal. So those institutions will pressurize their analysts to come out with buy signals. Or what does that mean? That means tell the customers that the security value, the value, what is the value? Intrinsic value of the asset is much lower. Tell the customers, so that they can buy, and after that we will see. But first of all, the target is the customer should buy, and so tell them that the intrinsic value of the asset is low. So the analyst will always try to see how to represent the data or the valuation reports so that the value of the security comes down. So that is one source of bias. And then the reward and punishment structure. For example, the equity research firm can link the pay of the analyst with how much close to the target value of the asset. So for example, the target value is $15 and the analyst is producing some valuation, say $25, then it will be towards the punishment side. But if he or she is producing a report like $10 intrinsic value, then okay, very good, $10, then reward. So like that. So if reward is towards $10, it is natural that the analyst will be biased towards $10. So like that. Okay. And so what is the manifestation of bias? First manifestation can be observed in terms of inputs. For example, inputs can be either optimistic or pessimistic. So based on your bias, how much biased you are, or the sources of bias, the manifestation can be either the assumptions will be optimistic or can be too pessimistic or too optimistic. Okay. Then the post evaluation tinkering. For example, your valuation says that the asset is $15 worth, and in the market it is $25. This is the market's estimate, and this is you. So then you will try to adjust these inputs and all these assumptions in such a way that it becomes somewhere like close to 25. May not be 25, but at least it should be 22. Otherwise, how could you justify your valuation? So you will tinker around and change your inputs and assumptions in any or every possible way so that it becomes close to 25. Okay. Then another thing is attribute the difference to some qualitative factor. For example, this 15 and 25. Oh, this is huge. There is a $10 gap here. So what could be done? So you will try to write stories like it is due to synergy, it is due to market condition, it is due to competition, competitors' pressure, and it is due to so many other things that you don't understand or even cannot be explained also. So you will see that all these factors are there. So therefore these $10 gaps are coming, and all these $10 is these factors are responsible for this $10. And so even if we have come out with $15 of share price, it should be $25. This will be the final report. So this is the manifestation of bias. So what to do about bias? Very simple. Reduce institutional pressure and dealing the reward and punishment with the valuation result. That means whether it is undervalued or overvalued should not be the basis of reward or punishment. What should be the basis? Basically the process. What processes are using, that means the analyst is using to evaluate the asset, how much accurate it is, or how much detailed work has been done. That should be the basis of reward or punishment. Then no pre-commitments. For example, the firm or the institution should not be pre-committed to some customer or to some other institution that certain value, certain undervalue or overvalued output will be given. So that kind of pre-commitments should not be there. And then awareness of bias is very important. So a person or an analyst should be aware that biases can occur, and it will occur in any way, in every way possible. So if awareness is there, then it can be controlled. And then finally, honest reporting, it has to be done. So whatever is found, suppose you are finding $10, so it has to be reported as $10, whatever be the market's own estimate. So these are the 5 points that can be implemented in order to avoid or reduce bias. But then, even if you have removed or completely eliminated the bias, which is of course not possible, but suppose it is possible, then even that occurs, there is a chance that your forecast or your valuation output is uncertain. That means sources of uncertainties will be there. So what are those sources? First of all, estimation inaccuracy. It is very well understood that whatever you are estimating is subject to your inputs, assumptions. By the way, we will see all these things in the subsequent videos. Don't worry too much about these things. So these are the sources of inaccuracy that will be there in your valuation models. So these are the estimation accuracies, and then the forecasting accuracy. So as I have told you, that cash flow, it can be present or it can be future. So future cash flow, how can you predict future cash flow? From, you are here in present, so you cannot go to future. You will use the forecasting techniques. Okay, by the way, I have published a business forecasting course in this particular channel. So I have given the link here in the top right corner here. So I hope that you will check that course also. It is a very good course on business forecasting. I have tried to cover all part of the forecasting techniques that is also related to this topic also. So if you are trying to forecast cash flow, some or many methods of those business forecasting series can be used in this technique also. So anyway, so what could be the responses? Responses are, for estimation accuracy, you just try to collect more information, try to be more detailed and accurate in your valuation project. And then for forecasting inaccuracy, what could be done? That is, instead of coming up with deterministic models, you try to project probabilistically. For example, instead of saying that the value of this asset is $10, you just say that it is between $9.5 to $10.5 with the 95% accuracy. So as if you are a statistician, which you are actually. So instead of saying something deterministic, try to represent the final report or the final valuation output in terms of probabilistic statements like this. Okay. So finally, the valuation methodology. What are the basic methodologies? So if you see the text or any book, there are basically 3 kinds of approaches. The first one is most popular, discounted cash flow. Second one is relative valuation, and the third one is contingent claim method. So in the first method, you have 2 kinds of approach. One is firm valuation, another one is equity valuation. And in relative valuation, we are not directly evaluating the firm, but trying to find the competitors data or competitors analysis, and from that data we're trying to project, since they are all also representing the same industry. So based on that data, we are trying to see for the similar assets what could be the valuation. So please understand that, suppose in an industry there are many players, P1, P2, P3 say, but if you look at them broadly, they will have almost similar assets. So if you can evaluate the assets of this P1 or P2 or P3 And then if you have a new player, say P5, then evaluating these assets and maybe trying to do some averaging will give an idea about the value of this asset. So this is the concept behind relative valuation. We will see in detail. So it is just an idea. And in contingent claim method, it is the option pricing model. Option pricing model. This will also be covered in the course. So no need to worry about this at this point in time. And for discounted cash flow models, for assets, we will try to see both existing asset and growth asset. What are the growth asset? Existing assets mean the assets that are already owned by the firm, and the growth assets are those that are not yet owned by the firm, but the profits that are earned are reinvested in order to purchase those assets in the future. And for firm evaluation, we will see the cash flows before debt payment and after reinvestment. So, if you want to see the total value of the firm, then you have to take the cash flow before debt payment. So, you are paying, suppose, principal plus interest. This is the payment for debt, the loans you have taken from the banks or financial institutions. You pay the portion of principal and interest every year or every month. You must take the cash flows before deducting those payments. But the reinvestment has to be considered because reinvestment is related to your growth assets. And for the equity valuation, you need to take the cash flow after the debt payments. That means you should not consider this principal and interest payment in case of equity valuation. But reinvestments anyway has to be considered because it is related to the growth asset. So that is basically the summary of the methods. We will see in detail in the upcoming videos. So that's it for now. This is the introduction part of this course, and we should have considered opening the discounted cash flow techniques from the next video onward. But before that, I will try to cover the time value of money concept in a 5 to 7 minutes video before that, because I am assuming that the viewers are new to this subject and they don't know anything. So before starting off this discounted cash flow, I would like to cover the time value of money concept. So that's it for now. Thank you for watching.